The COMEX has reported a 50 million ounce drain in registered silver inventories, and traders are now quietly shifting to cash settlement to avoid what could become the first major default in the history of modern precious metals markets. Physical refiners across North America are reporting delivery delays stretching multiple weeks despite premiums spiking to levels not seen since the panic buying of 2020. What we are witnessing is not a temporary supply hiccup or market correction. This is the moment when the decades-old paper-silver system collides with the hard reality of physical scarcity, and the implications stretch far beyond commodity traders and gold bugs. The registered silver available for delivery on the COMEX exchange has dropped below 70 million ounces. That number might sound large until you realize that open interest in silver futures represents claims on over 900 million ounces. Think about that ratio for a moment. There are more than 12 paper claims for every single physical ounce sitting in deliverable vaults. The system has always operated on the assumption that most contracts would be settled in cash, that physical delivery would remain the exception, not the rule. But something has shifted in the psychology of the market. Buyers are now standing for delivery in unprecedented numbers, and the vaults are running dry. Industrial users are scrambling. Solar panel manufacturers, electronics producers, and medical equipment companies depend on steady silver supplies to maintain production schedules. Reports from inside the supply chain indicate that premiums for immediate physical delivery have exploded. Wholesalers who could previously secure 1,000-ounce bars within days are now being quoted 4 to 6 week lead times. Mints around the world have slowed or suspended sales of retail silver products because they cannot source enough raw material to meet demand. The United States Mint itself has struggled with Silver Eagle production for 3 consecutive years, citing supply constraints that never seem to resolve. What traditional financial media is not telling you is that this is not just about silver. This is about the structural fragility of the entire paper commodity system and the trust that underpins global financial markets. When futures exchanges cannot deliver the physical asset backing their contracts, confidence in price discovery collapses. When industrial users cannot secure the materials they need despite paying higher prices, supply chains fracture. When investors realize that their paper claims may be settled in devalued currency rather than hard metal, the rush for physical assets accelerates into a self-reinforcing crisis. The silver shortage is the canary in the coal mine for a much larger problem. The question is not whether the paper system will break. The question is when and how violently. But to understand why this moment was inevitable, why the system is cracking precisely now, and what it means for your financial future, we need to go back to the origins of the modern silver market and the mechanisms that have suppressed its price for more than 4 decades. Silver has always occupied a unique position in the global monetary and industrial system. Unlike gold, which serves primarily as a store of value and monetary reserve, silver straddles 2 worlds. It is both a monetary metal with thousands of years of history as currency and an indispensable industrial commodity with applications in electronics, solar energy, medicine, and water purification. This dual nature has made silver a target for price suppression by governments and financial institutions that benefit from cheap commodity inputs and controlled precious metals markets. The modern silver market was fundamentally shaped by decisions made in the 1970s and 80s. In March of 1968, the London gold pool collapsed after European central banks refused to continue selling gold reserves to defend the $35 per ounce price mandated by Bretton Woods. The United States closed the gold window in August of 1971, ending dollar convertibility into gold. Silver, which had been officially demonetized in the United States with the Coinage Act of 1965, remained in a twilight status. It was no longer money in the legal sense, but its industrial demand was exploding, just as government stockpiles were being liquidated. The Hunt brothers' attempt to corner the silver market in 1979 and 1980 exposed the political sensitivity of silver prices. When silver briefly touched $50 per ounce in January of 1980, industrial users panicked and regulatory authorities intervened aggressively. The COMEX changed its rules mid-game, moving to liquidation-only trading that prohibited new long positions. The Hunt brothers were forced into bankruptcy, and silver crashed. The lesson was clear. Any attempt to drive silver prices higher through physical accumulation would be met with rule changes, margin hikes, and coordinated regulatory assault. The market learned that paper contracts could be manipulated, that exchanges would intervene to protect short sellers, and that physical delivery could be discouraged or prevented outright. For the next 4 decades, the silver market operated under a regime of abundant paper supply and controlled physical availability. Futures exchanges like the COMEX allowed the creation of unlimited paper contracts representing silver that did not exist in deliverable form. Large commercial banks took massive short positions that would be impossible to cover with physical metal. The concentration of short positions in the hands of a few major banks reached levels that would constitute manipulation in any other market. Official investigations by the Commodity Futures Trading Commission acknowledged the concentration but took no meaningful enforcement action. Whistleblowers from inside major banks testified about coordinated trading strategies designed to suppress prices during periods of high demand. The system functioned smoothly as long as buyers accepted cash settlement and did not insist on physical delivery. Government silver stockpiles provided a pressure release valve for decades. The United States Defense National Stockpile, once containing hundreds of millions of ounces of silver, was drawn down to near zero by the late 1990s. China and India, historically the largest accumulators of silver, became net exporters. As industrialization demanded dollars more than metal, mining production increased, but not enough to match the explosive growth in industrial applications. Digital photography consumed massive quantities of silver until the shift to digital imaging. But that silver was quickly absorbed by new demand from solar panels, 5G infrastructure, electric vehicles, and medical devices. By the 2010s, annual silver demand consistently exceeded mine production, and the deficit was filled by drawing down above-ground inventories. The crucial shift came after the financial crisis of 2008. Central banks around the world responded with unprecedented monetary expansion, quantitative easing, zero interest rates, and eventually negative rates. The purchasing power of paper currencies eroded steadily, while financial assets inflated into bubble valuations. Gold rose from under $300 per ounce in 2001 to over $1,900 by 2011. Silver followed, briefly touching $49 in April of 2011 before being smashed down in a coordinated takedown that saw 5 margin hikes in 9 days and a 30% price drop in a single week. That event reinforced the lesson that paper price suppression remained intact. But something changed in the decade that followed. A new generation of investors who grew up after the 2008 crisis began accumulating physical silver in small increments, buying 1-ounce coins and 10-ounce bars from retail dealers. These buyers were not speculators trading futures contracts. They were individuals removing physical metal from the market permanently, treating silver as savings rather than speculation. Reddit forums and social media communities organized around the idea of physical accumulation, explicitly targeting the paper market structure. The Wall Street silver movement that gained attention in 2021 represented a coordinated effort by retail investors to expose the paper-physical disconnect by demanding delivery and removing metal from the system. At the same time, institutional and sovereign demand began shifting. Central banks that had been net sellers of gold for 2 decades became aggressive buyers after 2010. By 2022, central bank gold purchases reached levels not seen since the end of Bretton Woods. If gold was being remonetized by central banks, silver as the poor man's gold attracted parallel interest from smaller nations and private institutions. Reports emerged of quiet accumulation by Gulf states, Asian family offices, and commodity trading firms positioning for currency instability. The 2022 sanctions on Russia and the freezing of $300 billion in Russian central bank reserves sent shockwaves through the global financial community. If dollar and euro reserves could be frozen by political decision, what were the alternatives? Physical commodities held outside the Western financial system became strategically attractive. For decades, this system seemed unshakable. The paper market could absorb any amount of speculative demand. Exchanges could raise margins to crush rallies, and physical buyers were too dispersed to threaten the structure. But something changed when the real economy began demanding physical silver faster than recycling, and mining could supply it. The energy transition to solar power became national policy across dozens of countries. Each solar panel requires approximately 20 grams of silver, and global solar installations are projected to more than triple by 2030. Electric vehicle production is ramping exponentially. and each EV contains approximately 30 grams of silver compared to 15 grams in traditional vehicles. 5G networks require significantly more silver per installation than 4G. Medical applications expanded during the pandemic and show no signs of slowing. The industrial bid for physical silver became structural, inelastic, and relentless. The registered silver inventory on the COMEX stood at over 300 million ounces in early 2020. By mid-2024, that number had fallen below 100 million ounces. The drain accelerated through the second half of 2024 and into 2025. In the first 4 months of 2025 alone, more than 50 million ounces have left the registered category. This is not a gradual trend. This is an accelerating collapse of deliverable inventory, while open interest and demand remain elevated. What does registered inventory actually mean? The COMEX divides its silver holdings into 2 categories. Eligible silver is metal stored in approved vaults that meets the exchange's quality standards but is not available for delivery against futures contract. Registered silver is metal that has been designated by its owner as available for delivery. When a futures contract holder stands for delivery, the exchange must provide registered silver. The critical point is that eligible silver cannot simply be shifted into registered status at will. The owner of that metal must agree to make it available. And right now, owners are choosing not to. The drain is visible in weekly inventory reports published by the exchange. In the second week of January 2025, registered silver fell by 12 million ounces in a single week. Major vaults operated by JP Morgan, HSBC, and Delaware Depository have seen sharp declines in registered metal. At the current rate of withdrawal, registered inventories could fall below 50 million ounces by the end of February. Open interest in the March and May contract months represents delivery obligations exceeding 200 million ounces. The mathematical impossibility of fulfilling all delivery requests, if even a modest percentage stand for delivery, is obvious to anyone watching the numbers. Traders with access to the physical market have begun reporting extraordinary developments. Wholesalers who normally handle large bar transactions describe a market where sellers have disappeared. One major dealer reported that offers for 1,000-ounce bars, which typically trade at modest premiums to spot price, are now being quoted at $3 to $4 premiums and still cannot be sourced in size. Retail premiums for silver eagles and maples have exploded to over $10 per ounce above spot. That spread is not a markup by greedy dealers. It reflects genuine scarcity at the retail fabrication level, as mints struggle to secure feedstock. European and Asian premiums have followed similar trajectories, indicating this is a global phenomenon, not a regional quirk. Refiners have become the choke point in the system. Silver mining companies produce concentrate that must be refined into deliverable bars. That refining process normally takes 2 to 3 weeks. Current reports indicate that refining backlogs have stretched to 6 weeks or longer. Refiners are prioritizing large industrial customers with long-term contracts, leaving spot market buyers waiting. This delay injects friction into a market that is supposed to be liquid and fungible. When buyers cannot convert mine supply into deliverable bars quickly enough to satisfy demand, the paper price becomes increasingly detached from physical reality. Why is this happening now? The immediate trigger appears to be a combination of factors converging simultaneously. Chinese industrial demand has resurged as the government pushes massive solar infrastructure spending to achieve energy security goals. Indian imports, traditionally driven by jewelry and investment demand, have remained elevated despite government efforts to discourage precious metal hoarding. Western investment demand has revived as inflation proves more persistent than central banks predicted and real interest rates remain negative when adjusted for actual price increases. The physical buyers from 2020 and 2021 never left the market. They have been accumulating steadily, and their cumulative impact is now removing enough supply to strain the system. But there is something more important happening beneath the surface. Sophisticated market participants have begun shifting behavior in ways that signal genuine concern about counterparty risk and settlement integrity. Futures traders, who would normally roll contracts forward to avoid delivery, are increasingly standing for delivery and immediately reselling the physical metal at a premium. This arbitrage should not exist in a well-functioning market. Its persistence indicates structural dislocation. Some traders are deliberately stress testing the system, forcing deliveries to expose the lack of underlying metal. Others are genuinely concerned that cash settlement might become mandatory if the exchange cannot source physical silver, and they prefer to secure metal now while delivery is still possible. Reports have surfaced, though difficult to confirm through official channels, that some large contract holders have been approached by exchange officials or commercial banks with offers to settle in cash at above-market prices. These quiet negotiations are designed to relieve delivery pressure without triggering public awareness of supply problems. If true, this represents an extraordinary breakdown in market function. Futures contracts exist to provide price discovery and guaranteed physical delivery. When exchanges begin paying premiums to avoid delivery, the contract loses its fundamental purpose. Traders lose confidence that their hedges and positions will settle as expected. The integrity of the entire price mechanism is called into question. What traditional media is not reporting is the connection between the silver shortage and broader monetary instability. Silver and gold have historically served as monetary alternatives during periods of currency debasement and financial system stress. The 2020 pandemic response involved the creation of more dollars, euros, yen, and yuan in 2 years than had been created in the previous decade. That monetary expansion drove asset price inflation in stocks, real estate, and bonds. But commodity prices were held down by supply chain collapse and demand destruction. As economies reopened, demand returned, but supply chains did not recover. The result was inflation that central banks initially dismissed as transitory, but which has proven structural and persistent. In this environment, precious metals become the hedge of last resort. Stocks are at valuations dependent on continued low interest rates and monetary expansion. Bonds offer negative real yields. Real estate is unaffordable for a generation of buyers. Cryptocurrencies have proven volatile and subject to regulatory crackdowns. Physical silver and gold, by contrast, have no counterparty risk, cannot be printed or debased, and have maintained purchasing power across centuries. The buyer demanding delivery is making a statement about trust in the financial system. They are saying that paper promises are not sufficient, that physical possession is the only true ownership, and that the time for trusting intermediaries has passed. The solar industry has become a silent but massive buyer of silver that markets have not fully priced in. In 2023, solar panel production consumed approximately 130 million ounces of silver. Projections for 2030 suggest that number could exceed 300 million ounces annually as countries race to install renewable capacity to meet climate commitments and reduce dependence on fossil fuels imported from geopolitically unstable regions. This demand is non-discretionary. Solar manufacturers cannot substitute another material for silver without sacrificing efficiency and reliability. They need physical silver, and they need it continuously. Unlike investment demand, which can pause or reverse, industrial demand creates a relentless bid that does not care about price in the short term. China has positioned itself as the dominant force in global solar manufacturing, controlling over 80% of polysilicon production and solar panel assembly. Chinese companies have been securing silver supply through long-term contracts with miners and refiners, effectively locking up future production before it reaches the open market. This strategic accumulation mirrors China's approach to rare earth elements and other critical materials. By controlling both the manufacturing and the material supply, China gains leverage over countries dependent on Chinese solar panels and the silver embedded in them. Western governments have begun to recognize this vulnerability, but building alternative supply chains takes years, and during that time, Chinese demand will continue absorbing available silver. The military and defense sector has also become a significant silver consumer, though exact figures remain classified. Silver's superior electrical and thermal conductivity makes it essential for missile guidance systems, radar, electronic warfare equipment, and communications technology. As geopolitical tensions rise and defense spending increases across NATO, Asia, and the Middle East, military demand for silver is growing. Unlike commercial demand, which responds to price, military procurement operates on strategic necessity. Governments will pay whatever price is required to secure materials for weapons systems, and that demand is never reported in transparent market statistics. The silver flowing into defense applications is removed from the market permanently, never to be recycled or resold. This is where the story gets really interesting. The concentration of short positions on the COMEX remains extreme despite years of scrutiny and allegations of manipulation. As of the most recent Commitments of Traders report, 4 large commercial banks hold short positions representing more than 250 days of global mine production. That level of concentration is unprecedented in commodity markets and would be illegal in equity markets under anti-manipulation rules. The banks argue that they are hedging legitimate commercial activity, but the scale of their positions far exceeds any plausible hedging requirement. The more likely explanation is that these short positions are part of a broader strategy to manage precious metals prices in coordination with central bank policy. When silver prices rise sharply, the public begins questioning the value of paper currency. Central banks want low precious metals prices to maintain confidence in fiat money. Commercial banks profit from paper market manipulation, while also serving as primary dealers for government bond auctions, creating a symbiotic relationship between monetary authorities and bullion banks. The suppression of silver and gold prices has been an unspoken pillar of the post-Bretton Woods monetary system. But that suppression depends on the availability of physical metal to deliver into the market during price spikes. If physical supply is exhausted, the suppression mechanism breaks, and prices can rise vertically as short sellers scramble to cover positions they cannot deliver against. The mechanics of a potential short squeeze in silver are different from the GameStop or meme stock squeezes that captured headlines. In equity markets, short covering involves buying back shares that were borrowed and sold. That buying drives prices higher, forcing more shorts to cover in a feedback loop. In commodity markets, short covering requires either buying back futures contracts or delivering physical metal. If physical metal is unavailable or prohibitively expensive, the short cannot cover. The exchange may intervene with forced cash settlement, position limits, or trading halts. But those interventions destroy the credibility of the market and trigger capital flight to alternative assets or exchanges. The COMEX has already lost market share to the Shanghai Gold Exchange and other Eastern exchanges that are perceived as more willing to honor physical delivery obligations. Documents obtained through Freedom of Information Act requests have revealed decades of coordination between the Federal Reserve, the Treasury Department, and major commercial banks regarding precious metals market intervention. The President's Working Group on Financial Markets, sometimes called the Plunge Protection Team, has statutory authority to intervene in markets to prevent systemic crises. While official interventions focus on stock index futures and treasury markets, circumstantial evidence suggests precious metals markets are also within scope. The timing of major silver and gold price declines often coincides with periods of dollar weakness or geopolitical stress when safe haven demand would normally drive metals higher. The intervention mechanism likely involves coordinated futures selling by commercial banks with implicit assurance that losses will be backstopped by regulatory forbearance or liquidity provision. This coordinated suppression worked for decades because physical supply was abundant and buyers accepted cash settlement. But now the refiners are reporting delays. Now the vaults are draining. Now the premiums are spiking. Now the industrial users are panicking. The system is being stress tested in real time, and the cracks are becoming visible. At this point, I need to step back from emotion and look at this through a realist lens. International relations theory teaches us that states act according to their material interests and that power, not rules or norms, ultimately determines outcomes. The same logic applies to financial markets. The COMEX and the commercial banks shorting silver have power derived from their position within the dollar-dominated financial system. They can change rules, manipulate margins, and settle contracts in cash because they control the infrastructure of price discovery and trading. But power is not absolute, and it is not permanent. The challenger in this dynamic is not a single actor, but a diffuse coalition of industrial buyers, retail investors, and foreign governments who prefer physical assets to paper claims. This coalition has no central coordination, no leadership, no unified strategy, but their collective behavior, the insistence on physical delivery, the removal of metal from the system, creates pressure that the paper market cannot relieve through traditional mechanisms. In realist terms, the balance of power is shifting because the material reality of physical scarcity is overwhelming the institutional capacity to suppress prices through paper creation. When established powers face challenges to their dominance, they respond with escalation. We should expect regulatory interventions, rule changes, and potentially forced cash settlements as the COMEX attempts to preserve its control. But each intervention carries costs. Forced cash settlement destroys trust and drives participants to alternative markets. Position limits alienate large traders and reduce liquidity. Trading halts create panic, and confirm that the market is broken. The more aggressively the exchange intervenes, the faster it loses legitimacy and market share. History is filled with examples of powerful institutions that overestimated their ability to control market forces. The London Gold Pool tried to defend the $35 gold price and collapsed when physical demand exceeded available supply. The Swiss National Bank tried to defend the euro peg and lost tens of billions of francs before abandoning the policy. The Hunt brothers tried to corner silver and were crushed by rule changes, but silver still rose from $5 to $50 before the intervention. Each case demonstrates that when price and physical reality diverge far enough, reality wins. The timing is uncertain, the path is chaotic, but the outcome follows from the underlying fundamentals. The silver shortage represents a collision between paper claims and physical scarcity in a market where physical supply cannot be increased quickly. Mining new silver takes years from exploration to production. Recycling provides only a fraction of annual demand. Above-ground inventories have been drawn down to dangerously low levels. Industrial demand is growing faster than supply. Investment demand is reviving as inflation persists. The gap between paper promises and deliverable metal is widening daily. The question is not whether this ends in a price spike or a market dislocation. The question is only how soon and how severe. In a functioning market, price would rise to ration scarce supply and incentivize new production. But the silver market has not been allowed to function that way. Prices have been managed through paper market manipulation to serve policy objectives that prioritize dollar stability and low commodity prices over accurate price discovery. That management worked while physical supply was ample. It is failing now that physical supply is constrained. The market will adjust, either through a sharp price increase that balances supply and demand, or through a breakdown in the futures market structure that forces a reset of the entire pricing mechanism. The realist framework also helps us understand why intervention is inevitable. Governments and central banks cannot allow a disorderly spike in silver prices because it would signal broader loss of control over commodity markets and fiat currency confidence. A silver price above $50 per ounce would immediately raise questions about gold, copper, oil, and other strategically important commodities. It would validate the concerns of inflation hawks and precious metals advocates who have been dismissed as alarmists. It would encourage other countries to accelerate their de-dollarization efforts and physical commodity accumulation. The stakes are therefore much higher than the silver market itself. This is about maintaining the credibility of the dollar-based financial system in an era of monetary expansion and declining trust. But intervention has limits. The United States government no longer holds significant silver reserves to dump into the market. Commercial banks can create unlimited paper contracts, but they cannot create physical metal. If industrial users cannot secure supply, they will bid prices higher regardless of futures market manipulation. If retail investors continue removing metal from the system, the drain will continue regardless of regulatory pressure. If foreign governments view silver accumulation as strategic, they will not be deterred by COMEX rule changes. The power to intervene in markets is real, but the power to override physical scarcity is not. This is not just about silver. The consequences will ripple across the entire commodity complex, the precious metals space, and the confidence in paper asset markets. If the COMEX cannot deliver silver, why should traders trust that oil futures, wheat futures, or copper futures will settle physically? If cash settlement becomes the norm for any commodity experiencing supply stress, the entire purpose of futures markets as hedging and price discovery mechanisms is undermined. Farmers hedging next year's crop, airlines hedging fuel costs, manufacturers locking in raw material prices, all depend on the certainty that futures contracts will settle as promised. That certainty is now in question. For individual investors and savers, this means that the premiums you see on physical silver are not temporary markups. They reflect genuine scarcity and the possibility that paper markets will not honor delivery obligations. Buying silver at today's premiums may seem expensive compared to spot prices, but if spot prices are artificial constructs maintained by paper manipulation, then the physical premium is the real price. The spread between paper and physical will continue widening until either physical supply increases dramatically or paper prices rise to reflect physical reality. Neither outcome is likely in the short term. For industrial users, the silver shortage represents an existential supply chain risk. Companies that depend on steady silver supplies to manufacture products are now facing the possibility of production disruptions, allocation systems, or long-term contracts at significantly higher prices. Solar panel manufacturers have already begun redesigning panels to use less silver per watt, but those redesigns reduce efficiency and take years to implement at scale. Electronics manufacturers cannot simply eliminate silver from printed circuit boards and connectors without compromising performance. Medical device companies cannot substitute inferior materials in applications where silver's antimicrobial properties are essential. The industrial bid for silver is inelastic, and that inelasticity will drive prices regardless of financial market manipulation. The political ramifications extend globally. Countries that depend on imported silver for industrial production are vulnerable to supply disruptions and price spikes. China's dominance in solar manufacturing gives it leverage over silver supply chains and pricing. Countries seeking energy independence through solar deployment may find themselves dependent on Chinese silver supply, creating a new form of strategic vulnerability. Western governments that imposed sanctions on Russia and froze its reserves now face the possibility that commodity-rich nations will respond by restricting exports of strategic materials like silver, rare earths, and critical minerals. The weaponization of finance is being met with a weaponization of resources, and silver is at the intersection of that conflict. The implications for the dollar are profound but indirect. The dollar's reserve currency status depends on deep, liquid markets for dollar-denominated assets and the perception that dollars can be exchanged for real goods and resources. If commodity markets priced in dollars become dysfunctional, if physical goods cannot be obtained at futures prices, then the dollar's utility as a medium of exchange and store of value is diminished. Countries holding dollar reserves want assurance that those dollars can purchase physical commodities when needed. If that assurance erodes, the incentive to hold dollars weakens, and the shift toward alternative reserve assets accelerates. Silver is a small market, but the precedent of paper physical dislocation carries systemic implications. The financial system itself faces questions about the validity of paper claims across asset classes. If silver futures cannot be trusted to deliver physical metal, can investors trust that their brokerage accounts actually hold the stocks they purchased? Can pension funds trust that their bond holdings will be honored in real purchasing power terms? Can depositors trust that their bank balances represent claims on real assets? The entire modern financial system operates on layers of abstraction, paper claims on underlying assets that are themselves claims on other assets. The silver shortage is a reminder that at the bottom of that pyramid must be something real, something physical, something that cannot be printed or created by accounting entries. When the real foundation is insufficient to support the paper superstructure, the edifice becomes unstable. Gold is the obvious comparison, and the next domino. Gold inventories have also been declining, though less dramatically than silver. The ratio of paper claims to physical gold held in vaults is estimated at over 100 to 1 in the London bullion market. If the silver squeeze triggers broader awareness of paper physical divergence, gold could experience a parallel crisis. Central banks have been net buyers of gold for over a decade, and their purchases accelerated after the Russian sanctions demonstrated the political risk of holding reserves in someone else's currency. If silver breaks the paper market structure, gold will follow, and the implications for the monetary system will be immediate and severe. Gold is still the ultimate reserve asset, the asset central banks hold when they no longer trust each other's promises. A gold price spiral driven by physical shortage would force a fundamental repricing of all financial assets. Energy prices are also connected through the solar industrial complex. If silver shortages disrupt solar panel production, the pace of renewable energy deployment slows, extending dependence on fossil fuels and keeping oil and natural gas prices elevated. The energy transition was supposed to reduce geopolitical energy competition and weaken petrostates. But if the transition is delayed by material shortages, the leverage of oil producers persists, and the petrodollar system remains entrenched. The silver shortage thus has the paradoxical effect of supporting oil prices and dollar demand in the medium term, even as it undermines confidence in dollar-denominated paper markets. In the next 5 to 10 years, we will see a restructuring of commodity markets toward greater physical settlement and away from the pure paper speculation that has dominated for decades. Exchanges in Asia and the Middle East that prioritize physical delivery will gain market share at the expense of Western exchanges that prioritize financial engineering. Mining companies will increasingly sell production under long-term physical contracts directly to industrial users, bypassing futures markets entirely. Investors will shift from ETFs and futures to physical holdings in allocated storage, accepting the costs of storage and insurance to avoid counterparty risk. The era of infinite paper leverage in commodity markets is ending, and the transition will be disruptive, volatile, and profitable for those positioned correctly. Central banks may be forced to revalue gold and silver reserves upward to restore balance sheet credibility. The official gold holdings of central banks are valued at historical cost, far below market prices. If market prices rise to levels that reflect true scarcity, central banks will face pressure to mark those holdings to market, which would create trillions in paper gains that could theoretically back new currency issuance. This revaluation has been discussed in academic circles for years as a potential solution to sovereign debt crises. The silver and gold shortages could be the catalyst that forces that revaluation into reality. The political and economic consequences of such a reset would reshape the global financial architecture as profoundly as the collapse of Bretton Woods or the 2008 financial crisis. The COMEX has reported a 50 million-ounce drain in registered silver, and the pace of withdrawal is accelerating. Premiums for physical metal have spiked to multi-year highs. Refiners are quoting delivery times that stretch weeks beyond historical norms. Traders are being offered cash settlements to avoid forcing delivery. Industrial users are panicking about supply chains. The ratio of paper claims to physical metal has reached levels that are mathematically unsustainable if even a modest fraction of contract holders demand delivery. What we are witnessing is not a temporary disruption caused by transient demand or logistical bottlenecks. This is the inevitable consequence of decades of price suppression through paper market manipulation, colliding with the hard reality of physical scarcity and inelastic industrial demand. The paper-silver system was built on the assumption that buyers would always accept cash settlement, that physical delivery would remain rare, and that prices could be managed through futures market intervention without regard for underlying supply and demand fundamentals. That assumption is now being tested, and it is failing. The market is discovering that paper promises are not the same as physical possession, that futures contracts are only as good as the exchange's ability and willingness to deliver, and that trust once lost is nearly impossible to restore. The realist framework tells us that when the balance of power shifts, established institutions resist and escalate before they adapt. The COMEX and the commercial banks will fight to preserve their control through rule changes, margin hikes, position limits, and potentially forced cash settlement. Those interventions will succeed in the short term, but at the cost of credibility and market share. Traders will migrate to exchanges that honor physical delivery. Investors will abandon paper proxies for direct physical ownership. Industrial users will secure supply through private contracts that bypass futures markets entirely. The structure that has defined silver trading for 50 years will fracture, and a new structure will emerge that reflects the reality of constrained physical supply and rising strategic demand. This move marks the beginning of a broader recalibration of commodity markets and monetary systems. The unipolar financial world, where dollar-denominated paper claims traded freely and universally, is giving way to a multipolar reality where physical possession, regional supply chains, and bilateral agreements replace globalized abstraction. Silver is the leading indicator because its market is small enough to be stressed by determined accumulation, but large enough to matter for industrial production and monetary sentiment. The lessons being learned in silver today will be applied to gold tomorrow, to copper the day after, and eventually to energy and food markets. The age of unlimited paper leverage in commodities is ending. The age of physical scarcity and strategic competition over real resources is beginning. The United States and its allies face a choice. They can intervene aggressively to suppress silver prices and maintain control of the paper market at the cost of credibility and long-term market integrity. Or they can allow prices to rise, accept the inflationary and confidence implications, and adapt to a world where commodity prices are set by physical fundamentals rather than financial engineering. Neither option is comfortable. Both carry risks. The decision will reveal much about the priorities and vulnerabilities of the current monetary system and the geopolitical order it supports. For those watching closely, The silver shortage is a live stress test of the financial system's resilience and the credibility of paper markets in an age of monetary expansion and declining trust. The outcome will set precedents for how future crises in other commodities and asset classes are managed or mismanaged. The question is not whether the system can suppress prices indefinitely. The question is how long it tries, how much credibility it spends in the attempt, and what emerges from the wreckage when suppression finally fails. This analysis is based on public information, market data, international relations theory, and the analytical framework of political realism. The interpretations presented are for educational and informational purposes.